Interesting.
And NASDAQ's up 0.75%.
So let's jump over to Starbucks. It's a stock that Jan wants me to look at. And the question is, so you're looking at Starbucks at these levels. Let's take a look. Year to date, Starbucks is down 7.7. Today, it is down 1.49. Over the 1 year, it's down 8.86. And they hired a CEO, and the CEO, created a splash, but the stock is not going anywhere over the 5 year. But looking at, and I'm going to love to see Daryl's charts on this because I think his work is going to reveal a lot. For now, I'll just say high level, this stock, the market and the company and the industry is not deemed to be very desirable by the market. The market cap of Starbucks is $95.95 billion. Revenues are nice and high. The PE is high, and we'll see the growth rate. I do have a valuation on Starbucks, and we'll look at that after we go over fundamentals. The forward P is 33.73. These two are high because they're not growing very well. If you have PEs like this, you have PEs like Nvidia. You have PEs like Microsoft. You have PEs like, this is higher than Google, and Google's growing at 13%, and their margins are massive compared to Starbucks. This is a restaurant. Margins are low. Analysts think it's discounted because they're basing this just on earnings per share. So let's take a look at their financials. So this is why the PE is high, in my opinion, is growth at 0.58%. Not good. And then growth for the full year, 0.5%. Now, this new CEO is coming in, and he's trying to get the company to grow at these levels. Okay. And so far, let's take a look at the quarterly. The growth is getting better. So we're up to 2.32%, 3.75. There was a string of 4 bad quarters, but it looks like they have gotten off the floor and are picking themselves up here. That looks a little better. So let's take a look at, while we're still in the quarterly, I want to look at the profit margins and see if they've improved. I also want to see maybe their free cash flow, but free cash flow may be something that we have to ignore a little bit. So gross margins actually have gone in the wrong direction. So we were at 25, 27, almost 28, 26.5, and then we got to 24.5, 21, not good, 22.8. Now, what could be eating away the gross margin? Gross margin is delivering one additional unit of your product or service. And delivering that unit, like we just talked about Seagate, you would deliver a physical product. You would put a product in a box and ship it to your customer. And that product would have material and it would have labor. The direct labor in order to assemble that product that you're putting in the box and shipping it to your customer. All variable product cost, prime cost, as accountants would call it, is what is calculated into gross margin. Each additional unit, Starbucks is making 22.8%. So the coffee, I think coffee prices are up substantially. And Starbucks has to be careful because if they start changing their menu and they go, hey, a cup of coffee, I don't go to Starbucks all that often anymore. So forgive me if I'm wrong on coffee drink prices at Starbucks, but I think last time I was there, if I order a 16-ounce coffee, it'd be about $3 in California. Well, if all of a sudden they're like, hey, we have a coffee surcharge and it's $5 cup of coffee, I'd be like, I'm out of here. Not only that, I'm never going to come back, or I'm not going to come back for a long time. So they have to be really careful with pricing. And I think they're taking it out of their margins because coffee prices are much higher, and that's eroding their profit. That's kind of a bad luck. That's not the company's fault. It's not management's fault. But as an investor, right, we're investors here. We're trying to put in $1,000, $10,000, $100,000 into a stock. And we want to wake up 5 years from now, and we want that to more than double in value, in price, right? We put in $10,000. We want to wake up 5 years from now, and it's $20,000, or even better, $30,000 or $50,000 of price. And we're like, great, mission accomplished. And when I look at a business like Starbucks, it's a restaurant. This is why I don't like restaurants, is they have to buy ingredients, coffee, milk, all kinds of, ingredients. They have to hire a large army of employees. They think of all their stores, all those employees, you have to pay them, you have to manage them, you have to hire them, you have to train them. I mean, it's expensive. So, and then the real estate that Starbucks has, it's not cheap real estate. You go to New York, Starbucks is all over the place. Well, I'm sure those corner retail spots in New York are very expensive. So you end up with a company that has a profit margin of 5.9. Historically, their best year is 11.5. That's just like, I don't want to be in that business. When I was a teenager, I did work in a restaurant. I know how hard these folks work. I respect it totally. But now I'm an investor putting capital out there that I've worked really hard to accumulate. I've earned it. I grow it. And this is why I don't like restaurants. It's not because I'm just out of thin air saying, oh, I don't like restaurants because I don't like restaurants. I don't like their margins. I love their coffee, sort of. I like other brands a little better than Starbucks, but that's just my preference. All right, so we're on the gross margins is not good. We're going to look at the forecast. I think their balance sheet's decent. I'm going to look at it just to make sure. 24 analysts are covering them. Now, Starbucks is a little bit of a, the press covers Starbucks big time. And I think it's a good story for the press because everybody understands what Starbucks does. A lot of people are Starbucks, customers. And, I get it. So these analysts are probably giving Starbucks a positive rating. And best rating is $115 stock. Worst one is 76. They're all basing it on earnings per share. Okay. Earnings per share is supposed to expand a little bit, and it's supposed to grow their revenues quite a bit. And they're going to make the PE ratio come down if their profits go up. But for now, it's just a really high PE. Again, I could buy with a 37 PE, I can buy some fantastic technology stocks. I could buy some stupendous healthcare stocks. I could buy so much better margin businesses with that type of PE. So let's look at the balance sheet just to make sure I'm looking at that. 27.9 billion. So they do carry a little bit of debt. And I don't think their debt to EBITDA. Well, it is getting a little concerning. 3.17. 3 is my limit. I think 3 represents a business that's in good condition. If you're under 3, you're slightly over 3. I don't think it's a big deal so long as they don't get any higher, but it's not a perfect balance sheet. All right. So that's where the fundamentals take us. Now let's take a look at the valuation for Starbucks. So I have a slightly higher discount rate because of their balance sheet. And this is no bueno. That's not good in Spanish. And it's just, man, Staying away from Starbucks. Don't want to buy Starbucks stock. No, thank you. I'd rather find the next high profit, high cash flow business to put my money in and avoid Starbucks for me. So that is Starbucks. Any comments on Starbucks, Daryl?
I got a chart.
Perfect.
So you've seen me use these charts before. This is a 20-year trend chart. I created this one 2 years ago, put this channel on here. So basically I try to connect the top blue line that's going across to as many tops as I can connect. And then I copy and paste that again and just drag it down and connect as many bottoms as it'll connect to. And you can see I created this 2 years ago. There were a lot of people I was working with that were really excited about Starbucks. And I tried to show them this chart that says they're basically falling out of a 20-year trend channel. A 1 month trend channel doesn't mean too much, but when you look at 20 years worth of data, it means a whole lot more. So once it started breaking out of that 20-year trend channel, to quote Victor, it was no bueno. So even though when they got the new CEO, there was a lot of excitement. I mean, he's very talented CEO. He did great things for Chipotle Mexican Grill. Took that stock to incredible heights. I'm sure he'll probably do well here, possibly. But look where the stock is even after his announcement. A lot of people bought in up here, excited for these changes, and now it's sitting at $84 a share, back where it was in April of 2024. So we'll look at a more current, or not current, but we'll look at a 1 year chart. Basically, they've been trading sideways for 3 months since 4 months since June, been trading sideways, and now they've started on another decline back to they're not very far away from the April and May lows. They're trading below their 200-day, 50-day, and 20-day, and all of those are downward sloping. So they got a lower RSI, PPOs in negative territory. Money flow has been negative since July. So as far as I'm concerned, this would be a no-go.
I agree. And I want to quote Mr. Buffett, the great Warren Buffett. And he basically, when you look at a company, do you buy a company because of the CEO, or do you buy the company because it's a great business? And it's the latter. He doesn't buy businesses because of a great CEO. He buys the business. Now, is it positive to have a good CEO? Absolutely. It's better to have a great CEO. But you put a CEO in charge of, a highly valuable business, let's say a Palantir. I think any CEO would probably see the stock just flourish because the fundamentals are so darn good. Whereas you get a business that has low margins, there's going to be some positive there, but it's the business itself is what I'm focused on. I have very little. I can't say that I'm completely oblivious to the management team. And I would also say that some managers, like the Intel CEO, he did terrible things. So I would say I'm not oblivious to it, but I would say I look at the core business. Thank you, sir. Jan, thanks so much for your question. That was a good one. Thank you, sir.